You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing,
Hello, I'm Deidre Woolard, an editor at Millionacres, and thank you so much for tuning into the Millionacres Podcast. So if you follow this podcast, you know I love to talk about real estate crowdfunding and all of the opportunities it represents. It's really my goal for people to understand what real estate crowdfunding is and how it can be an accessible way to build wealth. And when it comes to accessibility, I feel like there's no platform kind of more well-known than Fundrise. They're the ones we get the most questions about because they advertise a lot. And I've been a Fundrise platform member for a couple of years. One of the things I really enjoy about the platform is their commitment to communication about every phase of investment. So I'm excited to talk to Ben Miller, who co-founded Fundrise in 2012. Welcome.
Thanks for having me.
Well, Fundrise is kind of the OG in this space, right? You started before everybody else and you've just continued to grow. How did you start at a time when there wasn't really a lot else out there in this space?
We started right after the 2008 financial crisis. And at the time, I had been disillusioned by the system. Basically, the banks had blown up the country and then gotten bailed out, right? And I said, well, there's got to be another way. There's got to be a different system. Can we basically have like real people investing in real things away from the street? And that was the sort of the idea. But to make it possible, I spent a year plus working with the SEC, just like trying to figure out how that could be like, what's the regulatory framework? What's the way that they would permit it? And it's one of those things that in retrospect everybody looks at as obvious, but until we did it, no one had ever done it before. And I remember I actually went to New York to meet with the number 2 law firm in the country, the head of their securities practice, head of their real estate practice. So here's what we want to do. We want to democratize investing in real estate, open it up, basically sort of use the technology, use the internet to lower the barriers. And the head of the practice said to me, why would you bother with a little guy? He's used to having billion-dollar clients and stuff. And so that's what was the mindset before we came along. It's just like how people thought about it. And I think that's no longer true.
And you came along really before 2012 and the Jobs Act. You came along before any of the things that kind of made crowdfunding more understandable. So before the SEC had even changed laws, right?
Yeah, I mean, we were working with the SEC. I think it helped them understand it better by seeing us do it. The actual property that we built, that was the first deal that ever real estate crowdfunded, was like down the street from the SEC. And we turned it into this like restaurant. And actually that place is now a rite of passage for people who go work at the SEC. They always take them there for lunch. So it's like, so I think it helped people go from theoretical to practice by actually seeing it. I think we played a little part in that transition.
So let's talk a little bit about the structure of Fundrise. Is it because you started so much earlier that your structure is a little bit different than some of the other offerings? Is it also because you're sort of open to everybody with a relatively low entry point?
Yeah, I think it's a combination of two things, like idealism and realism, if you will. So on the idealistic side, want to like fully democratize it, open up access, use technology to make it basically super low minimum, like basically frictionless. If we could get the cost down to zero, we would. I mean, it's as low cost as possible. That's the idealism. And the realism is, I've been doing real estate for 20 years. You need to have a structure that's flexible for when things go wrong, or even when things go right, that you can write a check, you can make decisions. And so we moved to a fund structure or a pooled structure, which is much more more resilient to shocks, and also lets you basically drive it more like a business. It's more like an operating business than like a static property.
Interesting. So one thing I've noticed with Fundrise is And one things I like about Fundrise is that your thesis keeps evolving with changes in the world, build to rent, single family rentals. You've kind of kept moving as you've seen the market move. How do you do that, and what goes on behind the scenes as you evolve your strategy?
Yeah, right. So that's exactly right. So my father used to say, my father's a real estate guy, and he used to sort of in Washington, D.C., somewhat well-known real estate developer. And he would always say, real estate's always in motion. And people don't see that. They see a building and they think basically it doesn't change. But it's always changing. And if you think about retail, how much it changed in the last 20 years because of technology, because of e-commerce. If you aren't thinking about trends and how business basically is dynamic, you're going to lose value. Your asset will depreciate. So our theses or our different strategies have, generally I think we've stayed a step or two ahead. So back in 2010, 12, 13, 14, 15, we were investing in emerging neighborhoods, right? Brooklyn to Manhattan, LA Arts District versus West Hollywood. And that was like where the growth was. Then we shifted to moving to like what was called Class B multifamily. That was about a change in people moving south to Texas and Florida, affordability, better quality of weather, and maybe cost of living. And so those trends basically are key to basically capturing value in real estate. And that's a combination of basically data, good judgment, and being able to execute on them, like having the actual like technical capabilities to know how to build an apartment building or invest in industrial e-commerce.
So you said your father is in real estate. Is that sort of what led you to be interested in real estate? Did you kind of grow up in it, and is that sort of why you saw that maybe it wasn't as accessible as it could be?
Yeah, I think it gave me a longer view of it. I mean, so he's almost 80, so my father has been in it for a long time, and people look at real estate and they say this is how it's always been, but it hasn't. It's actually gone through a number of revolutions. It sort of goes through this evolution every 20, 30 years. So before 1992, if you look at real estate in the 80s and the 70s, it was all individuals. There were sort of no institutions like we think of institutions today. It was all, they were called syndicators. It was all raised by accountants and lawyers, and then in the early 90s, basically the S&L crisis transformed the industry, institutionalized it. That's when Blackstone and Goldman and Starwood basically got introduced. They got invented as real estate investors in the early 90s, and there's a whole interesting backstory around that. So people, if you have a broader understanding of sort of the arc of history, you can sort of both get a sense of what could be possible that people don't see, and also a sense of where things probably are headed over time.
Yeah, I like that idea of the sense of history, because one of the things that I've thought a lot about with real estate and how it's evolved lately is tracking how REITs started from when they were founded in the 60s to sort of now kind of grown up, fully part of the stock market. Everyone knows REITs, invests in REITs, but it wasn't that way a couple of decades ago. They weren't really, they just weren't seen as great investments. So I feel like real estate crowdfunding is kind of following that path, where it's been, right now it's still in the people know about it, but they think it's risky or something like that phase.
Yeah, it's funny. Because of the family connection, I know people who were in doing the first REITs, like the first UPREITs. They were, and that was Taubman and basically, like, I think it was in I can't remember what year it was, but it was like there were some pension fund advisor asked the guy who invented the Wilshire Index. He said, "Well, these REITs ever amount to anything? Like, is this ever? Do I even have to care about this?" And whatever. 20 years later, it's $1 trillion, massive amount of assets. And so like what we're doing, using the internet to invest in real estate, to me, I don't call it crowdfunding. It's basically just how everything's going to be done, how everything's done, e-commerce, insurance. There's like nothing that technology won't basically be the medium for, because it's basically clearly superior to do it with an app and lower cost and better data. And so it's at some point, I think probably at the end of this decade, will actually be the sort of like one of the mainstream institutions. Even it's going to be sort of like a funny that's how sort of the evolution of it works, and that that brings, like, when you become the mainstream, right? Your challenge is, how do you innovate? How do you actually continue to grow? Because usually at scale, you sort of move to a mediocrity.
That's a good point. Well, let's talk about that nomenclature for a second, because I understand your issue with real estate crowdfunding. It gets too close to crowdfunding, which just sounds, like GoFundMe or Kickstarter or anything else. Is there a better term to call it? Is it an investing platform? Is there something that you've settled on that kind of encompasses what you feel like Fundrise slots into?
I'm waiting for some journalist to coin a new name. I look forward to it, because I've talked to them and they say real estate crowdfunding. I'm like, well, we've grown now. Our funds are 40 Act funds, like mutual funds. They're registered with the SEC. They're the same fund structure or similar fund structure you'd see with like BlackRock or Vanguard. BlackRock and Vanguard raise money on the internet mostly too. So I'm like, why are we not what they are? Like, what's the difference here? And it just happens to be that our sort of mutual fund, if you will, is real estate properties, and theirs are stocks. But it's the same regulatory construct, and so we got there over time. We evolved to that more sophisticated, like pretty serious regulatory burden. It's no joke being a 40 Act company, but it's exactly what it'll be called, right? That I'm hoping so. I never came up when I first came up with Fundrise, I called it online syndication, right?
Okay.
That didn't catch on.
Interesting. Well, one of the things I think with Fundrise that's interesting is the accessibility factor, right? So accreditation is something that's been changing. You're obviously shifting your business a bit to kind of meet the growth of the business, it sounds like. How much is what the SEC does like an impact for you, and how do you think about it going forward?
Yeah, we're in Washington, D.C. Even from the beginning, 10 years ago, we worked with the SEC to figure out sort of how do we do it where they were on board, right? And now we're 9 years later, and we have what are equivalent mutual funds, investment companies, and all of that innovation over those years required us to be closely connected to the commission. And I would say, like, we're probably corresponding, on Edgar and with SEC like daily. So like it's critical to it's sort of core to our business, and it's core because it's always been about everybody should be able to invest. There should be no artificial barriers, and that means it's highly regulated. So our investment minimum over the last number of years has come down basically. We have investors who are investing millions, and investors who invest like a $10 minimum. And $10 minimum is because the software doesn't really care. It's basically a zero marginal cost. Once it's in bits or zeros and ones, the software basically is agnostic to how many people it is. And that's like been always part of the core aim, right? To use software to break down the barriers.
So is Fundrise open to institutional investors as well, or is it just it's all retail investors that are some large, some small?
I've worked with institutions. I've had them as partners before I started Fundrise. I basically have a dim view of institutions. I think that it's there's a lot of middlemen, a lot of bad incentives, and there are obviously great institutions out there, but what they want from you is different than what an individual wants. An individual wants good performance and transparency, and institutions, like, core to at their worst, but even core to their existence, is they want CYA. They want to not be able to, like, the person takes career risks, they can't get in trouble. It creates a different incentive structure. And so we have eschewed, we basically have avoided institutions as a client for our company.
That makes sense. So talking about Fundrise's structure a bit, I know that you have the EREITs, which is sort of how it started, and there's different EREITs that are invested across different properties. Can you explain a little bit about how that works and the ways in which you're evolving that structure?
Our investors basically, like what we try to offer, what we try to build for our investors are real estate strategies, not like you're picking, I think this building on 3rd and Main and Dallas is where you should be. Like I think that's not really how most people want to invest. What they want to invest in is certain strategies that deliver outcomes that they're looking for. And so we have at the highest level, we have strategies that produce income or yield, and strategies that produce long-term high growth. And then underneath of that, you basically have so what's high growth these days? Mostly residential in the Sun Belt, either as build for rent single family homes, which I think is basically the future. I mean, it's basically the future of real estate is single family housing for rent. I mean, it's basically going to become the most dominant part of real estate for the next 10 years. It's going to outperform. I think we're the biggest BFR, build for rent buyer in the country. We are just completely dominant in that space. And actually institutions that we compete with are potentially we've displaced them completely. It's not really, they don't really understand that yet, but it's I know that because the people who work there are coming to me saying, well, I might as well work for you because I can't actually buy anything that I want because you're already basically there before us, or basically have control or the dominant player in the pipeline. So that's basically the sort of ideal outcome, right? The ideal outcome is you have the right strategy, best technology, the lowest cost, and you're a dominant operator in the space. So that's basically it's not a deal, it's not a building, right? It's about an operating platform that you can have huge leverage, and it can only be achieved basically underneath what we put as a fund or a strategy.
Interesting. So for a Fundrise investor, if someone's thinking about Fundrise, one of the questions that we've gotten a ton is Fundrise versus publicly traded REITs and how people should be thinking about the two options. Yeah,
we get that question all the time too. I mean, it's there. I have a few different ways to answer that because I think it's a deep question. So one, what's the difference between high-tech, pre-IPO companies and late-stage, like IBM, mature public tech companies? Mostly the public markets are where mature companies go. They're usually lower growth, more what the analysts on Wall Street wants is predictability, and that basically generally has had lower returns. The last few years have sort of seen some interesting dynamics on the street because of, I think, all the money printed, but sort of put that side as maybe an aberration and say public markets are where mature companies go and private markets are where basically higher growth, higher risk, higher return. And that's just the fundamental difference. And that's, if you look at the REIT industry, most of the REIT returns have come from the new REITs, cell towers, e-commerce logistics. There's only a handful of public REITs I think are actually really growth stocks. The majority of them are actually maybe like a utility or something.
Yeah, I think that's a fair assessment of things. All right, let's take a quick break here.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co.
Some of our listeners are undoubtedly among the fortunate group sitting on piles of valuable tech stock. If you're one of them, listen up. Urban Catalyst could help you with your tax bill when it comes time to sell. Urban Catalyst is the premier qualified opportunity zone fund based in Silicon Valley. And if you meet investors' qualifications and invest in a qualified opportunity zone fund, you could potentially get big tax breaks. Here's how it works. When you go to sell your stock, you will likely generate a large capital gains tax bill, which means Uncle Sam may want to take a large chunk of it. If you're not keen on sending all that money to the U.S. Treasury, Opportunity Zone funds like Urban Catalyst can help you shield those gains. And Urban Catalyst isn't just any Opportunity Zone fund. Forbes magazine and the Sorensen Impact Center ranked Urban Catalyst one of the top 20 OZ funds in the country. Don't wait too long. If you invest before the end of this year, you may not only defer capital gains taxes, but you also may be able to reduce your capital gains by 10%. And as an added incentive, if you hold your investment for 10 years, you will likely not have to pay any federal taxes at all on those gains. And it's not just stock sales. Capital gains from real estate sales, selling your business, or even a big crypto sale, these types of capital gains can all get potentially favorable tax treatment by investing in an Opportunity Zone fund. Urban Catalyst focuses on development in downtown San Jose, an area prime for growth and revitalization. You can learn more about the fund and the numerous development projects underway by visiting urbancatalyst.com/millionacres. But keep an eye on your calendar. You only have 180 days after your capital gains event to invest in an Opportunity Zone program. So visit urbancatalyst.com/millionacres today.
I'm back with Ben Miller, and we're talking about Fundrise. I wanted to get into some specific transactions that caught my eye recently. You just talked about build to rent. One of the things I noticed last year was you had the first community deal with D.R. Horton, which I think kind of kicked off the trend of build to rent. And as you mentioned earlier, there's been this kind of scramble right now with build to rent at the same time that you've got individuals looking for homes. Home builders can't build fast enough, and they're facing supply chain issues and construction issues, and price of land is going up. How are you looking at all of those issues, and how big do you really think build to rent can get? I mean, you said before you kind of think it's the future.
Yeah. So there's so many interesting things in that comment. So let's talk about the institutional or investment side and the sort of effect on home buyers. So every institution wants to own single family and build for rent. Mostly they're buying existing single family, so it's not like they're building new homes. We felt like our customer wants us to basically expand the pie, doesn't want us competing with the homeowner, so we went out and focused on build for rent. And when we bought the D.R. Horton deal, basically like in some ways we came out of nowhere. And at the time, people were like, "I wonder if they're overpaying." And now, looking back in a year, we just like we look like the smart money, right? With rent growth and occupancy on that property, you're like off the charts, 100% occupancy. Just we killed it on that investment. And so basically, I think that at the most fundamental level, the homeowner is competing with institutional money for housing. Institutional money is competing with the bond market for yield. And so it's like they're just operating on two different levels, two different worlds. And that dynamic, I think, is basically until we move into a different interest rate environment, which I think is I'm not sure how to call that one. This is here to stay. And then on top of that, basically, we're just underhoused. There's just not enough housing in the country. And if people use these big numbers as 1.5 million houses they need to be built, but really people aren't moving to Buffalo, right? They're moving to the growth is happening in Texas and Florida, Phoenix, so it's actually much more concentrated where the housing need is and where the growth and demand is. So I think that there's millions of houses need to be built in these areas, and I think that's literally going to happen. And I think build for rent is basically changing how the home building industry works, and because it's bringing kind of a new part to these home building businesses. Because before you build for a home buyer, and the home buyer, you have no idea what home prices or home buyers will be like a year from now. but like you have like a stability in your business model if you have a partner who basically will buy with you and rent. And it's just I think it just de-risks the home building industry.
Yeah, it's sort of amazing to me because you think about the great financial crisis, 2008 to 2011, and then there was no real backstop for home builders. They built, and then there was no home buyer who wanted them. So, I used to live in Los Angeles. You had out in Lancaster, you had the pads. Home builders just stopped building in some of the exurbs. Now, if there is another slowdown in home buyer demand, there's going to be Invitation Homes and the iBuyers and so many different other solutions that didn't exist a decade ago. It's really wild to think about.
Yeah, I've been trying to explain this to like reporters who call me about this stuff. It is because it creates a floor for home sales that didn't exist. Like you said, no 2008, there was no floor. Like basically, just the prices could go to almost to zero. Like in some home, I was in real estate back then too. You could look at a 300 unit single family house development and literally get to a negative land value. So this is worth negative $7 million, right? That's how upside down it was back then. And now, like the nature of SFR, single family rental, it's just created a floor on the home building industry. And the home building industry, as a result, is just sort of in transformation. It's in transition from like a binary industry, right? Either boom or bust, to like a more analog industry. And that, I'm not good at buying stocks, but I feel like the home building industry may be mispriced by the street as a result of this like fundamental change in their business model.
Yeah, I would definitely agree with that. I want to talk to you about this project that you actually are doing in Los Angeles. You're kind of taking on a whole neighborhood, which I find fascinating. So what is Fundrise doing with the West Jefferson neighborhood?
So, this goes back to kind of where we started. We have been focused on emerging neighborhoods. It's less of a focus now, but it definitely was a part of our core strategy, and this neighborhood is sort of part of that, which is that you go to where it's really, really expensive, where everybody wants to be, and then you go one neighborhood over, right? You just say, okay, so in LA, you go to Culver City, super high priced, real estate. You go one neighborhood over, which was West Jefferson neighborhood, and it was like, difference was like, $1,000 a square foot versus like $300 a square foot. And I like to say that like affordability is like gravity, like it just will pull people over so we bought like 25 buildings in that neighborhood, and it brought in like restaurants and video streaming companies, agencies, and essentially now that neighborhood, like CoStar, which is like how people find space, like now is starting to treat West Jeff as part of Culver City. It's just like over time, like difference between Williamsburg and Manhattan is like almost immaterial from a pricing point of view. You could have closed the affordability gap. And that's how you make money. That's one of the ways you make money in real estate.
Did you get any concern from the neighborhood about gentrification and things like that?
No, I have a lot of experience on this topic. It's an industrial neighborhood, so there really wasn't housing. There was no displacement. We aren't building much housing. It's mostly, there's a certain type of tenant, which is like a single-story creative office space, which basically the pandemic's driven more demand for. People want to get out of office towers into like a kind of old industrial building with sort of big bow wood like ceilings, and have their own space, be outside. And so we focus on a type of redevelopment that doesn't have a lot of the issues with gentrification. We opened up a Black-owned bookstore in the neighborhood, which was part of basically, making it a place. Basically, like, it didn't have much character. It wasn't like a vibrant part of it, if you drove by it before. And I think like 3 years from now, if we do it really right, it's like Abbot Kinney was, like just a really cool street with really high rents and a great sense of like character.
So you just mentioned that sort of commercial office switch from towers to different types of real estate. Seeing the same thing on multifamily too, that there's just been this run on garden style apartments. And I know that you've been looking at buildings like that. Do you feel like is that a pandemic response or is that an ongoing shift?
Yeah, that's a really good point. And we own something like 20,000 multifamily units like that in the Sun Belt. So we made like large investment on that thesis, and that thesis is now playing out. We're seeing rent growth at just like double-digit rent growth. Like everybody wants to buy it from us, and I think we're going to see like good outcomes from that. We got sort of ahead of the part of the magic is be ahead of the institutional money. Institutional money is actually really slow. Really, like they don't want to do anything first. They want to basically know it's proven out before like they jump in. And so I'm like, well, that's great because like it's not that hard to be faster than like a slow moving giant. So we got there first, and then you sell it to them, like hopefully close to the peak as possible. How long that's sustainable? That's a good question. I mean, like, I'll give you some numbers just so you can understand. Like when we're buying, this is Class B multifamily is multifamily housing built in the 80s, right? That's what it basically, like, essentially, mostly it is. We would buy it for like $60,000 a unit, $80,000 a unit. You put in $10,000 renovating it, and like now, like 3-4 years later, people are offering to buy for like $250,000 a unit, $230,000. I mean, just huge appreciation. And what happened is that the price differential between new construction or new housing and old housing basically almost closed, because you can make it more or less new for a small amount of money, $15,000 a unit or less. And so like that strategy is sort of it's played itself out. We stopped buying Class B multifamily, and we only started buying Class A multifamily. And that's basically saying, well, if I'm going to buy housing and apartments in Austin, do you want to pay $250 a unit for a new construction or $225 a unit for housing from the 80s? And well, it doesn't make sense. Let's just buy Class A. And so we did, and then that went to $300. So now we're like, the problem is there's so much money pouring into anything with yield. It's pushing us and pushing. I mean, this is where we go. Where you say, okay, well, you need to build more things. You need to build. You can't just like harvest yield. And so that's like becoming a greater and greater part of our strategy. And I think you can build for a lot less than you can buy. I mean, a lot less. I mean, the gap is basically going to come. I mean, I'll just give you again numbers, like probably build for $200,000 a unit, and you have to buy for $300,000 a unit. So that's a huge delta, like as big as I've ever seen. So you build. So but that requires a whole different amount of operating capabilities.
And requires more time.
Yeah, and if you've ever done any large scale development, it is grindy, very grindy.
That is a good way to put it. Do you feel like we're overbuilding with luxury apartments? You know, it seems like there's a lot of high-rise towers being built. There's a lot of concern about, hey, we don't have enough workforce housing, but we have all this high, Class A that we might not need.
Yeah, well, so I think there's like a few different ways to cut that question. Fundamentally, there's no such thing as new workforce housing, because the cost of new construction is, whatever, $200,000 a unit. There's this sort of like workforce housing is usually, housing from the 80s, housing from the 70s, that's just the nature of housing. It's like saying a used car versus a new car. There's no such thing as a workforce new car, right? It's a new car versus a used car. Used cars are $5K and a new car is $30K. So that's like the press always says, why don't they build workforce housing? I'm like, well, it's basically impossible. So it's like that's point one. But then like on the question of are we overbuilding it? In New York, we got out of New York. We stopped investing in New York in 2016. We were heavily invested up to 16. They just got too affordable. I thought they were overbuilding. They, $2,000 a square foot for a condo, and they overbuilt in New York, and now they're really in trouble. They were in trouble before the pandemic. So I think, are they going to overbuild in Austin? I don't think we're anywhere close to it. So there's too many tailwinds because we didn't talk about remote work and remote work technology. But that's the new. We didn't see that coming back in 2018 or 17 or 19 when we were buying in Austin or Tampa. But if you can live anywhere, you're not going to live in whatever DC. You're going to move from DC to basically places that are much less expensive and have great weather. And that's driving the rental market, residential market, in ways that I think are secular, long-term driver.
Well, let's talk about another overheated area where investor money is going, and that's industrial and logistics. You touched on it earlier. It's just been nuts. I mean, price per square foot in industrial just keeps getting out of control. What are you thinking about that space now? Is it something you're investing in, or is it's getting too overheated for you?
Yeah, we are investing in it. I mean, mostly we need to go to new construction. Build is not enough supply. There's some interesting dynamics around it that I think the price per square foot is less important in that situation because Amazon or Shopify, whoever your user is, they're not thinking. They get so much leverage out of that building outside DC or outside wherever Charlotte, that the price you need to be thinking about supply. It's not like affordability is for a homeowner where there's sort of certain limits. There's no limit Amazon can pay for the right building in the right place because they have technological leverage that it's like data center, right? What's the actual? It's there's sort of you can't just look at it on a per square foot basis. So, and it's very difficult to bring new supply into Washington D.C. There's just very limited amount of industrial space, and they're mostly losing industrial zoning as people convert it to residential, like we did in LA. We're converting industrial space to creative office and restaurants and stuff like that. So and residential. So basically, you have declining supply, a sort of virtual demand because of technology. And so I still think there's good fundamentals, but the actual, when you go for a stabilized, when you're actually in an auction dynamic for a sort of Class A industrial building, the price is ridiculous, absolutely ridiculous. We went in for a bid, the whisper price was $35 million, and it sold for $45 million.
Ouch.
Nobody knew what, it was just crazy. So that you don't want to do that. Okay, so I concede that the pricing is out of control, but there are also fundamental drivers. So it's rather than what I was saying in office in New York 2 years ago when it was just going to the moon, I'm but is there really the same fundamental drivers for office in New York? The affordability problem is like a headwind.
And especially with industrial right now, you have one of the things we've seen is, okay, there's Austin, obviously, which you mentioned, and Charlotte, which you mentioned too, the secondary markets where people are moving to, and there's not enough industrial space at all. And then you've got Amazon building airports, trying to solve this problem. So you've really got whole industrial markets springing up that didn't even exist before. It was a conversation previously about last mile warehouse. Now it seems to be warehouse everywhere. Essentially, if you take,
I think I can't remember the numbers were, but X number of retail space in the country, something 300 million square feet, it was some number. And essentially, that will end up 100 million square feet of industrial. If you just sort of say, for every 3 square feet you lose in retail, I think you end up with 1 square foot industrial. Some ratio, I can't remember off the top of my head. So that's what's been happening. And then another driver, we're in the market, right? Amazon is 50% of the industrial e-commerce market. So, and if you're counterparty, that's a difficult negotiation because it's a one-sided power dynamic. So it's when you get into it, when you get underneath it, what's the supply constraints in Charlotte? Who are the tenants? Can you get zoning done? Because actually, a lot of times neighborhoods don't want industrial in their neighborhood. They fight you. So building new supply, there's tons of value in doing it, but it's challenging. Like the negotiation for the lease, the building of it, all of the location. So that's why I still think there's really strong fundamental drivers. You want to just capture it as like affordably as you can.
Yeah, that makes sense. So I really enjoy the Fundrise app. I get the alerts a lot. One of the things I was wondering is how you go and how you get all the information. It seems like you must have a big team to kind of do that. Is it something that's really important to you? Is that idea of communication with participants, with Fundrise members?
Right. So Fundrise is like 200 people now, which blows my mind. I still think we're like 7 people and my dog and in a little alcove. So, but we're like obsessed with the customer. We're basically like we have these company values. Probably every company has them. One of our first one and our main one is investor first. We put the investor first. That's like, and people will do things that are like absurdly like just dramatic, just to deliver for the investor. Like as an example, I think it was in Dallas. Some home builder delivered us like half a dozen houses with no refrigerators. So we can't get refrigerators. And we're like, so somebody flew to Dallas, went to Costco, bought 6 refrigerators, and took them to the houses, and now we have 6 houses. So basically like, I guess that was a bit of a digression, but the point is that what's different about us, and something that people don't appreciate the power of, is we are vertically integrated from you holding that app to the software that manages all the capital flows, all the information, to the fund, to the operation, to the property. There's nobody in the middle. We're the information, the people, the incentives are all one. And I think over time, that is going to be what it should be to drive better performance, more information, better transparency, just better outcomes. And it's what you saw like Amazon do, Netflix do, where they basically completely vertically integrated to deliver for the customer. And that's the ethos. And you see that in the consumption of the app. But over time, I think you'll see that as we write more and more software and do more and more things that just you can't do with people if you're an old-fashioned real estate company.
Interesting. So one of the things that I've seen, I don't know if this is just a perception thing, but it seems like deals are moving faster. And one of the things we've noticed with Mogul, our premium service, is things are being sold early for some of the crowdfunded deals that we had with other platforms. Is this something you're seeing, that there's so much capital that deals are transacting more quickly?
Right, for sure. I mean, we saw it on 2 of our strategies. We made a lot of loans, and we gave a lot of mezz, or like second tier, like called like preferred equity or mezz loans to multifamily. We had $300 or $400 million of it out. It was great during the pandemic, right? Like March 2020, when everything collapsed, and you were like, "Oh my God, what is going to happen?" Those loans were just pristine, right? They never missed a beat. They always paid. And then like the economy came roaring back, and everybody's paying them off, right? They're just paying them off, like 12%. Perhaps it's like, forget it. So like that's kind of the nature of why I'm saying real estate's so dynamic. You have to go ahead, and if the market catches up with you, you harvest. It pays off or you sell, because once it's sort of at maturity, it's sort of fully baked. Like, there's not that much of like sort of value creation left, and you move on, and it's like you're not emotional about it, and so I think that's basically what's happening, and the hard part is not so much harvesting something that we were right about, right, but it's the hard part is making sure that you get the best price, and then you invest in the next thing.
Well, I got to ask, what's the next thing?
I mean, it's built for rent. I mean, here I'll give you an example. So we did a $300 million financing with Goldman Sachs for our build-for-rent portfolio. It's the only build-for-rent at scale on the street. Like literally, if we go do a securitization, and we talk to the investment rating agencies, they've never seen it, right? They've never seen a $500 million portfolio built for rent. And the build for rent, what's so like, the way we're doing it is we build 50, 100, 200 homes in one place. So you get like sort of the best of two worlds, right? One, a home is the best consumer product. If you're a consumer, you want more light, backyard, more space. You want all these things you can't get from an apartment. So it's as a consumer product, like our app, it's a consumer product. So we've built something people want, and you build it with 100 homes, so it operates like a multifamily property. So the cost of turns, turning people in, cost of turns, cost of renovation, there's all these scale benefits, and we're basically achieving both those things. And no one's ever done that, and we're dominant in the space. So I just think we're going to get more dominant and deliver, I think, pretty good results for people because of the tailwinds around work from. If you're going to work from home, and you're only going to the office once or twice a week, you're going to move further out. You're going to want a house. You're going to want and you probably you'll rent. So it's just so fundamental to, I think, the mega trend underneath of growth that like we got there first, and then we're like been able to kind of solidify our position in a way that like a year or two from now, the institutional investors, like at some point they start to like they won't understand how we did it. Like, what, you're just supposed to be crowdfunding. It's supposed to be like kids. This is not how it's supposed to work. We're supposed to be the big guys. You're supposed to basically be like irrelevant. And like, I'm hoping that basically they continue to underestimate us long enough that we basically get there with software that they sort of can't do anything about it once we're there.
All right. Well, that brings me to my last question then, which is the future of Fundrise. Sounds like you're moving fast here. Are you looking at some of the things that are out there that right now, like emerging models of tokenized real estate, property trading via NFTs? Is there anything like that kind of catches your eye, or is that sort of fringe for you guys?
Yeah, I mean, we are focused on the application of technology to real estate finance. There's so much. It's just like incredible how much there is left to do. Crypto is tricky because you sort of say there's two reasons why. I always say, like, well, what's the problem you're trying to solve? And why does that problem have to be solved by crypto? And mostly, I haven't seen that many technological problems solved by crypto. Like to decentralize it, it's like, no, you have to have somebody driving the decision making. Who's going to go pick up the refrigerator and get it to the house if it's decentralized? Where there needs to be it's an operating business. Real estate's an operating business, like Google is an operating business, not like a brick of gold. And so I don't know how to leverage crypto, and as you probably know, like Gensler, SEC, they're about to crypto is about to get completely disrupted by the regulator. That's like imminent, and I think that out of that wreckage, there should be some really interesting opportunity. But in the meantime, we're sort of use software to like get data out of the properties, aggregate it in like sophisticated ways, look for insights, that kind of stuff. It's not that fancy, but it really delivers good results.
Any thoughts on prop tech in general, things like digital twins, adding more sensors to buildings? Is that something that you look at as well?
We have a technology initiative coming that we haven't talked too much about. Like, obviously, we have all these 100 software programmers, and we what's unusual about us is that we actually are 100 software programmers, 100 real estate people. So you're 100 real estate people or 100 software programmers. You're not, and they don't really understand each other, and they don't know how to solve the right problems. So so we're actually started investing in prop tech companies. We started like looking for how we can leverage our expertise and our technology and our scale to do that. So I'll give you an example. There's a company called Saltbox. They are kind of the WeWork of industrial. So if you sell on Etsy, if you sell on e-commerce, and you need 400 square feet to deliver 10,000 units a year, you can't get that from an industrial building. Like you have to rent 20,000 square feet, not 200 square feet. So they've created this sort of WeWork model where there's a much clearer value proposition and there's a huge premium because you're not paying for square footage, you're paying for a service, which is to fulfill your logistics needs of your business. And so they basically did that. We invested into their company and we're rolling out. We're going to, the goal in motion is to be the real estate underneath of all of their buildings. So we'll own it, build it out for them, scale it across the country. And that's like a unique partnership that we can do that I think is not so common.
Well, Ben, thank you so much for your time. This was really fantastic. A reminder to listeners, you can learn more at fundrise.com. You can always email us at media@millionacres. Stay well and stay invested.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discussed at Million Acres, or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.